In 2007, Warren Buffett made a public bet. He put $500,000 on the table and said a simple index fund would outperform any collection of hedge funds over 10 years. The hedge fund managers chose their best funds. 10 years later, the index fund returned 85.4%. Source: Warren Buffett Annual Letter to Berkshire Hathaway, 2017. The hedge funds returned an average of 22%, the most sophisticated investors in the world. The best funds they could find. 10 years. The index fund won. This episode answers the question episodes 1 and 2 left open. You know why to start. You know the habits that matter. Now, where does the money actually go? What is an index fund? Why does it beat most professionals? And how do you buy one in under 10 minutes? An investment banker, a hedge fund manager, and an index fund walk into a bar. The index fund orders for everyone. The banker asks, "How?" The fund says, "I own the bar. I own every bar. I have since day one." This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. Episode 1 established the wealth building window. Episode 2 showed the 3 habits that separate very different retirement outcomes on the same salary. This episode answers the question both left open: where does the money actually go? One quick thing before we start. This channel does not take sponsorships from financial products. Every recommendation in this episode is based on published data only. If that matters to you, the subscribe button is below. The SPIVA Europe Scorecard, published by S&P Global in 2023. Source: SPIVA Europe Scorecard, S&P Global, 2023. Over a 15-year period, 88%, same source, of actively managed funds in Europe underperformed their benchmark index. Not just slightly, the median active fund underperformed by 1.5 percentage points per year. These are professional fund managers, teams of analysts. Decades of experience, 88% of them did worse than an index that owns everything and charges as little as possible. An index fund is a fund that owns every company in a given market index in proportion to their size. The MSCI World Index covers approximately 1,500 companies across 23 developed countries. When you buy one unit of a MSCI World Index fund, you own a fraction of all 1,500 of them. Apple, Toyota, Nestle, HSBC, all of them, at once, for one purchase. It does not try to pick the best companies, it owns all of them. And that is why it works. The fee difference is where most of the performance gap comes from. The average actively managed fund in the UK charges between 0.85% and 1.5% per year. Source: Vanguard Fee Impact Modeling, 2023. The Vanguard FTSE All World Index Fund, VWRL, charges 0.22%. That 1% difference compounds. Every year, whether the fund goes up or down, the fee is charged regardless of performance. I thought picking the right stocks was the point. Is it not about finding the next big company before everyone else? The SPIVA data covers 23 years of professional fund managers trying to do precisely that. Source: SPIVA Europe Scorecard, S&P Global, 2023. After 15 years, 88%, same source, of them underperform the index that owns everything without trying. Identifying which 10% will outperform in advance has no reliable method in 50 years of academic research. The 30-year rule. In every decade since the 1970s, the distribution of outcomes for active fund managers has been consistent. Roughly 10% outperform the index in any given decade. Different 10% each time. No persistence, no reliable signal. The ones who beat the index one decade underperform it the next. Selecting them in advance is not an investment strategy. It is a coin toss with higher fees. So the index fund is not the lazy option. It is the option that works. I thought index funds were risky because you own every company, including the bad ones. Is it not dangerous to own 1,500 companies at once? The risk of owning 1,500 companies is lower than owning 10. When one of the 1,500 fails, you lose a fraction of your portfolio. When one of 10 stocks fails, you lose 10% overnight. Concentration is the risk, diversification is the management of it. The MSCI World Index has recovered from every single drawdown in its 55-year history. Source: MSCI World Net Return Index Historical Data, 169 to 2024. The worst single-year loss, 40.3%. Same source: in 2008, recovery to the previous high, 4 years. The dot-com crash of 2000 to 2002, recovery in 5 years. Every financial crisis in the data, recovery. Each time, because the index owns the entire market, and markets recover. So the index fund has never permanently lost money over any 20-year period in 55 years of data. Correct. Source: MSCI World Net Return Index Historical Data 19069 to 2024. The risk retail investors are most afraid of. Permanent loss is not what the 55-year data shows. Here is the fee maths in full. £50 a month for 30 years. MSCI World Real Return 7%. Source: MSCI World Net Return Index 2024. Active fund at 1.2% annual fees. Final value approximately 127,000. Index fund at 0.22% annual fees. Final value approximately 158,000. Source: Vanguard Fee Impact Modeling 2030. Same contribution, same market, same 30 years. The 0.98% fee difference, £41,000. I thought I should wait until I understood investing better. Is it not irresponsible to invest in something you do not fully understand? The ONS Wealth and Assets Survey 2022 found the average UK investor waits 4.2 years between first intending to invest and actually doing so. Source: Office for National Statistics Wealth and Assets Survey 2022. The reason given in 71%, same source, of cases, wanting to learn more first, in that 4.2-year wait at 7% real return. Source: MSCI World Net Return Index 2024. £50 a month compounds to approximately 2,800 of unrealized growth. Waiting to understand it fully is more expensive than starting before you do. An index fund is not a complex product. It is the simplest financial product that exists. It does one thing: it owns everything and charges as little as possible to do so. The sophistication is in the structure, not the selection. You do not need to understand every company in the index to own it. You need to understand one thing: that owning the whole market at low cost has outperformed active selection in 88%. Source: SPIVA Europe Scorecard S&P Global 2023 of 15-year periods measured. So the reason most people do not do this is not because it is too complex, it is because it sounds too simple. And simple does not feel like it should work. The evidence says otherwise. Which index fund and how to buy one? For UK investors, Vanguard VWRL or VWRP, the FTSE All-World Index Fund. Annual fee, 0.22%, approximately 3,700 companies across 47 countries. For Australian investors, Vanguard VGS or BVWL. For Canadian investors, Vanguard VXC. Step 1. Open a Stocks and Shares ISA. Step 2. Search the fund by ticker. Step 3. Set a monthly direct debit. Step 4. Do not look at it daily. Do it once, make it automatic, then leave it to run. Right, quick one. 30 seconds. Stay with us because this is the part most people miss. Same £50 a month, same 30 years. Same market returns, the single difference is the fee. The index fund charges 1% less per year. That 1%. Source: Vanguard Fee Impact Modeling, £2,000 by the end. £41,000 that the active fund manager kept. Not as performance, as fees. Right. Back into it. Lightning round. 5 facts, 90 seconds. 88%. Source: SPIVA Europe Scorecard, S&P Global, 2023. Of active fund managers underperformed their benchmark index over 15 years. Identifying which 12% will outperform in advance has no reliable method in 50 years of academic research. A 1% annual fee difference over 30 years on £50 a month cost $41,000. Source: Vanguard Fee Impact Modeling 2023. That is 68% of total contributions. The fee takes more than 2/3 of what you put in, not from returns, from contributions. The MSCI World Index owns approximately 1,500 companies across 23 developed countries. Source: MSCI World Net Return Index 2024. The 10 largest holdings make up about 20%, same source, of the index. The other 80% is spread across 1,590 companies. No single company failure can take down the fund. Buffett's 10-year bet S&P 500 Index Fund returned 85.4%. The 5 hedge funds selected by the other side returned an average of 22%. Source: Warren Buffett Annual Letter to Berkshire Hathaway 2017. The index outperformed all 5. Every single one. Annual fee on Vanguard VWRL, 0.22%. Source: Vanguard 2024. The average actively managed global fund, approximately 1.2% per year, same source. On $300,000 accumulated over 30 years, that 0.98 percentage point difference is worth approximately 87,000 tons in final value. The 1% detail for this episode. John Bogle founded Vanguard in 1974 and created the first index fund available to retail investors. At the time, the investment industry called it un-American, a product designed to settle for average. By the time Bogle died in 2019, Vanguard managed approximately $5 trillion in assets, the largest fund manager in history at that time, built on a product the industry said would not work. Source: Vanguard Corporate History, 2019. The product that settled for average outgrew every firm that tried to beat it. What they never tell you. The Financial Conduct Authority published a study on fund fee disclosure in 2021. Source: Financial Conduct Authority 2021. It found that 63%, same source, of retail investors in the UK did not know the total annual cost of their investment funds. Not a rough idea. They did not know at all. Of those who guessed, the majority underestimated their fees by more than half. The fee was always disclosed. In the documents, on the fact sheet, it was disclosed in a way most people did not find. Episode 3 showed what an index fund is, why it works, what it costs, and how to buy one. Episode 4 asks the question that stops most people at this exact moment. Your index fund drops 20% in a single week. You get an alert on your phone. Every financial headline is catastrophe. What do you do? The panel question for this episode. Kai wants to know if now is a good time to buy an index fund. Maya says there is data on that. Nadia says the question itself is the problem. Marcus has heard it every year for 30 years and has a consistent answer. Their disagreement is in the comments. Leave yours. The two curves you are about to see are both you. One put £50 a month into an index fund at 22. One put the same £50 into an active fund. Watch what the fee difference does to the gap over 30 years. The gap between those two lines is not market performance. It is not investment skill. It is a fee charged every year whether the fund goes up or down. Next episode, your index fund drops 20% in a single week. What do you do? The data on what most investors do at that moment and what it costs them is the most important episode in this series. Friday. Subscribe, new episodes every week. Kai bought his first index fund after filming this episode. He searched for VWRL in his ISA provider. It came up immediately. He clicked buy. He set up a monthly direct debit for £50. The entire process took 6 minutes. He then spent 45 minutes reading about which index fund was better than the one he had just bought. Next episode is up there. Subscribe is over there. Both are better than whatever you are about to do instead. I know this because I have watched the next episode. I understand all of it. I have done approximately none of it yet. That is what the subscribe button is for.